Welcome to the fourth session on commodity derivatives and risk management. In the previous session, we discussed about the different aspect of futures contract specification, and we will continue from the last session. Let's go to the MCX cotton futures contract, which we started discussing in the session 3. So now let's go to the delivery and settlement. Here I would like all of you to pay attention to the word delivery logic and compulsory delivery. So what exactly is this compulsory delivery or delivery logic? I will explain little later. Suppose let's say on 29th of June 2016, the June contract comes to an end, and on that day you have around 400 contracts open. That means 400 long futures contract or 400 short futures contracts are available to be available with the different trading traders. So that means because the delivery is compulsory delivery, so all long position holders will take delivery of the underlying goods, and the short position holders will be delivering the underlying, that is 400 contracts into 25 bales. So 400 into 25, so whatever that amount comes to, that will be 10,000 contracts will 10,000 bales of cotton will be delivered in the through the exchange platform. So how the delivery this particular delivery pay in, delivery pay out. So E plus 1 working day by 5 p.m. So E stands for expiry. So delivery pay in means the short futures position holder will provide the warehouse certificate to the exchange or to the clearing house by E plus 1 work, that is expiry plus 1 working day, and by 5 p.m. So the short futures holders will provide the warehouse receipt, which has been quality certified and assayed as per the quality specification mentioned in the earlier part of the contract specification. Now delivery pay out of the commodities, that is the exchange will pay or transfer these warehouse receipts to the long futures position holder on E plus 2 working day after 5 p.m. that is expiry plus 2 days. Similarly, pay in of the funds, that is the long position holder will be paying money to the exchange, so they will be paying money by 11 a.m. So E plus 2 working day 11 a.m. and pay out of the funds will be, that is the exchange will pay money to the short futures holder on E plus 2 working day after 2 p.m. So if you see the sequencing of these 4 things, that is delivery pay in, delivery pay out, pay in of funds and pay out of funds. So the short futures holder will pay warehouse receipt first, then only the exchange will transfer the money to its account. Similarly, long futures holder will first pay money to the exchange, then only the exchange will transfer the warehouse receipt in their name. And this, if seller defaults, what will be the penal provision? If buyer defaults, what will be the penal provision? The penalty will be charged by the clearing house. However, the clearing house will abide by the counterparty's payment and receipt through its settlement guarantee fund. Now, we have discussed already due date rate, and the standardization of the contracts also indicates who bears the warehousing expenses. So borne by the seller up to the commodity payout date, and borne by the buyer of the commodity after the commodity payout date. Now the delivery can happen in additional delivery center. Now if the sellers, instead of delivering at Rajkot, if they would like to deliver, or they have the goods already stored at exchange approved warehouses at locations which are other than Rajkot, like let's say Yavatmal in Maharashtra, or Mundra in Gujarat, or Kadi in Gujarat, or Jalgaon in Maharashtra, all this, they will be receiving lesser amount. They will not get the due date rate amount, that is the spot price calculated on the contract expiry date. They will be getting a lesser amount, so discount amount per bill. So they will be getting less amount because the buyer of the commodity is will be incurring certain expenses for transferring goods from the these warehouses to Rajkot warehouses, as if not necessarily the buyer will transfer the warehouses, but actually the price negotiated is with respect to as if delivery is going to happen at Rajkot. So if a seller, short futures holder, is delivering at any other exchange approved warehouses, there will be a discount. He will not be getting the full amount. Similarly, quality premium and discount. Many times, if the commodity underlying has some quality variations, but within the whatever has been mentioned as per the quality specification, but some minor variations are there. There can be some premium or some discount associated with it. So you have rest of the other things which are mentioned, and this brings an end to our discussion on standardization of commodity futures contract. Now let's understand a little more on how open positions or open interests are calculated at exchanges. Let's say on 1st May 2016, let's say a trader wants to take a long futures position on 12 cotton contracts, and who is the counterparty? Counterparty is a trader B. Of course, trader A would not know, or there is no way of trader A knowing who is the counterparty. So it is the anonymous order matching. Exchanges provide anonymous order matching system. So you will know that whether your order has been executed or not, but you will not get to know who is the counterparty. Anyway, you don't need to know, because as per the novation, you are the exchange becomes a counterparty to each and every trade which gets executed in a commodity exchange. Now after this trade, both A and B have 12 open positions. So A took long position in 12 futures contract, B took short futures position in 12 contracts. So both parties now have 12 open positions okay, there is a mistake on my part. Please it's not December 2016 contract, this is October 2016 contract. So now let's say on the same day, that is on 1st May 2016, on the same day, suppose trader C and D took long and short futures positions in 30 contracts each. So C takes, let's say, long futures position on 30 contracts, D is taking as a counterparty same 30 contracts. Now open interest increases to 42. Now this particular, let's say, cotton futures contract, so on May 1, trader A took long position on October 26 cotton futures contract, October 2016 maturity contract for 12 contracts. Who is the counterparty? B, and B also took the same 12 contracts. So what is the open interest? Open interest is 12. Similarly, on the same day, C takes long futures position on 30 contracts, D takes the short futures position on 30 contracts. So you have now open interest as 42 contracts. Now suppose these are the two contracts which got executed only on day 1, that is 1st May. May 2 you have E took 7 contracts and E took 75 contracts and G took 75 contracts. So now open interest increases to 42 plus 75, that is your 117. Now let's say on 2nd May, D, who had earlier taken 30 short futures contract, would like to square up its position. So when we are talking about the word square up, means if you have taken long futures contract on a commodity underlying for a specific maturity, you can square up that particular position by taking a short futures position for the same number of contracts for the same underlying and same maturity. So let's say D would like to square up the position by taking 30 long futures contract for October 27 maturity on contract. So D took long futures contract, and who is the counterparty? K. So K is now the new counterparty. So now if we see from the D's point of view, D does not have any open position. D had initially taken 30 short futures and D squared up this by taking 30 long futures position. So what happened to our open interest? Open interest remains unchanged. Similarly, 2nd May you had L taking 1100 contracts and M taking, suppose let's say 1100 contracts. So this is a theoretical example. We discussed that maybe as an individual client somebody cannot take more than 48 contracts at a given point of time. Let's say ignoring that fact. So let's say L took 1100 contract and M took 1100 L took 1100 long position and M took 1100 long position. So what happened to the available open interest? So that is 1217. Now on May 3rd, suppose G, which are earlier interested to take, earlier had taken short position, would like to square up its position, but not fully but partly. Let's say G would like to square up position 12 contracts, and who is the counterparty? Like G, A is also interested to square up position. So A had earlier taken long futures contract, it will be able to square up its position by taking short futures contract. So what happens to the open interest at that point of time? Open interest is 1200.05. So so how exactly this 1200.05 is calculated? 1205 indicates the available number of long futures or short futures contract available to be squared up before maturity. As on that date, this many contracts are available to be squared up. So we have to calculate either the long side, long future side, or the short future side, not both. So let's say on this date, May 3rd, so the exchange will report how many open interest available. Open interest available is 1205. So how this 1205 has been calculated? C has 30 long futures, E has 75 long futures, L has 1100 long futures. So sum total of it is coming to 1200, or if we consider from the short side, short future side, B has 12 contracts, G has 63 contracts, K has 30 contracts, and M has 11 contracts. Please note that the number of traders need not necessarily be same. However, the number of open positions for either from the long side or the short side has to be same. You can have a different numbers of traders, but you can have, but you have to have the same number of long futures or short futures position. Now, so let's say for a specific trader, let's say the same trader which suppose on May 1, X took long position on 25 contracts and trader A took short position in 25 contracts. So please ignore this. This is not the same. A is not here. So you are another, or it could be the same. It could be the same trader. So A had taken 12 contracts on May 1, long futures position on October 27 contracts 12 units, and on the same day A also took 25 short futures contract for November 2016 maturity. So that means on May 1st, trader A has 35 open positions, 12 for October maturity and 25 in November maturity. So combining both October and November contract, A has 37 open contracts, 37 open positions. So out of which 12 is for October maturity and 25 is for November maturity. Now, how do then we summarize how open interest gets calculated? When two new traders enter into positions, open interest increases. When one existing trader squares up with another new trader, open interest remains unchanged. When two existing traders start squaring up with each other, open interest goes down. As I mentioned, squaring up means closing an open position, and long futures position can be squared up by taking short futures position for the same contract and the same maturity. And as you recall, in the previous session we discussed that exchanges limit the amount of open interest a client can have at a given point of time. So exchanges limit the open position for a trader or trading member so that no trader has the power to manipulate the market. So at times, in fact, there's something interesting I thought of sharing with you all. At times traders take long futures position, that is in the futures market they take long position, and simultaneously they take long position in the cash market. That means they start buying and acquiring the physical underlying. So they now have a long futures position and they own the asset, underlying asset. And when they are owning the underlying asset, specifically in a situation where you do not have more of the underlying available in the market, that is in a situation of a supply constraint, they acquire the cash, they take position in the cash market, they buy the underlying, put it in warehouses or godowns and do not release them into the market, and simultaneously take long position. And when the contract approaches the maturity, if they would like to take delivery, that means the short futures position holders have to buy underlying from somewhere and give it to the exchange as part of the delivery. So anyway, these long position holders by that time has already cornered the market, and cornered the physical market means they are now owning the underlying assets, and there is not much of an underlying asset available in the spot market. So what happens? Price rise happens in the spot market. This is typically called a squeezing the shorts or cornering of the market, and that leads to many a times a unusual increase in the spot price. So that is the reason why many a times futures trading has been blamed for excess price rise in the underlying commodities. Now, as we discussed that clearing houses charge different types of margin, in this session we will discuss what are the different types of margin are charged by or levied by the exchanges, and how some of the margins gets calculated, not margins gets calculated, how the margin rates gets calculated. Exchanges required traders to pay different types of margin. So one of the the cotton contract, if you recall, has 4% as the margin, and I also mentioned that both long and short futures position holder, whenever a trader takes his order gets executed, he or she has to give the initial margin. Both long and short futures position holders have to give the initial margin. So how the initial margin? So suppose this margin percent is 4 as for the cotton contract it was 4%. Number of contract, let's say in our case the trader A took 12 contracts, and price per contract. So whatever price he, the rate at which his order, the price at which his order got executed. So multiplication of these three will give the initial margin. So and who collects the initial margin? Clearinghouse collects the margin from the trading member on behalf of the trader in the form of cash, fixed deposit and bank guarantee. So as I mentioned, if I am a client, whether I pay margin or don't pay margin, that is, a clearinghouse does not worry about it. If I have a trading account with, let's say, ICICI Direct or Kotak Securities, these two bodies are answerable to the clearing house for depositing the margin money on my behalf. So it becomes the responsibility of these brokers or trading members to collect the margin from me and deposit. If somehow they are not been able to collect the margin, or they are to increase the trading volume, they are giving me some benefit of collecting less margin from me, then they have to give whatever the margin required on my behalf. Now let's see, does initial margin vary from commodity to commodity? This particular slide screenshot, which I have taken from the National Commodity Derivative Exchange website, this shows, if you focus on little bit, this particular, so 6 column shows the initial margin levied by the NCDEX. So you have the maize, for maize, which is maize Rabi, for a contract which is maturing on 26 July and which is the spot date. So this is the information which is available. I collected from the 9th June 2016, that is on 9th June 2016, the 20th July contract had 4% margin. Similarly, for all maize Rabi has 4%, maize Kharif has 4%, Kapas has 4%. But let's say, interestingly, let's say Jeera Unjha, that is Jeera Unjha means the Jeera to be delivered at the Unjha market. So Jeera Unjha, which is maturing on 28th October, that has 4%. Jeera Unjha, which is maturing on 20th September has got 5% as initial margin. August contract has 5.31%, July contract has 5.25%. And so it is very, very clearly visible that initial margin varies across commodities, and also initial margin can vary for different for the same commodity but for different maturity. Besides the initial margin, there are other margins like extreme loss margin, pre-expiry margin or delivery margin, and there are other margins, additional short, long and special margin, all these are there. So let's go to understand how exactly initial margin percentage gets calculated by the exchange. What is the basis on which exchange announced that the initial margin is going to be 4%, 5%, 6%, whatever that may be. Initial margins are based on value at risk methodology. So maybe many of you, as part of your financial derivative, you may have read what is a value at risk methodology. I will be briefly taking you through what is a value at risk methodology and how VAR methodology is calculated for used for calculating the initial margin. Let's say, what is a value at risk? Again, there is a mistake on my part. Value at risk is always had a small a, it is a capital A here. So VAR measures the potential loss of an asset or portfolio of asset over given time horizon for a given level of confidence. Now, how exactly value at risk is calculated for a futures contract? So volatility of futures prices is considered for the computation of VAR. So daily volatility is calculated based on the historical return series. So the exchange takes cognizance of the futures prices. From the futures prices, daily futures prices, it calculates the daily return series or volatility, annualized volatility, and how exactly the value at risk of the asset is calculated. Value at risk of the asset is calculated. Value of the asset into annualized volatility of the asset adjusted for a given time horizon into standard normal value for a given confidence interval. So let's take an example how exactly it will be calculated. Let's say on 1st May 2016, based on the historical annualized standard deviation for cotton futures, analysis of annualized standard price of cotton futures indicates that the volatility is 24.35%, and we need to calculate the VAR for 1 day VAR for 99%. So how do we go about it? And here my assumption is that the exchange operates Monday to Saturday, that is 6 days a week. So that is the reason why I have taken number of trading days as 305. If in India now we have exchanges operating from Monday to Friday, that is 5 days a week, so this number will be reduced to 252. Now with let's say assumption of 252 days trading days, with the assumption of 305 trading days, let's find out what is going to be the 99% 1 day VAR for a commodity whose the futures annualized volatility based on the futures price is for 24.35%. Now this is the calculation. So annualized volatility is 24.35%. I'm sure all of you know how to calculate the annualized volatility. You can download the futures price from the exchange website and find out the continuous compounding return, that is ln PT by PT minus 1. So today's price by yesterday's price, natural logarithm of that will give you continuously compounded daily return, and you can find out the the standard deviation of that series and multiplied by square root of 252. Square root of 252 is going to give you the annualized return volatility. So volatility, so you have annualized volatility of 24.35%, volatility over the VAR horizon, that is 1 day, annualized volatility into square root of 1 by 305. As I mentioned that I have assumed that the exchanges operate from Monday to Saturday, that is 6 days a week. That's the reason why I have taken 305 as my number of trading days. So that comes to so volatility over 1 day is 1.39% when my annualized volatility is 24.35%. So I require the my confidence interval is 99%. So that means the corresponding standard normal value is 2.33. And what is the important assumption here, that the futures price or futures returns follow a normal distribution. So that's a very, very important assumption we are making here. So based on that, we are finding out the 99% confidence, the standard normal value for 99% confidence interval. So you have, so that comes to 2.33. So now we have a VAR margin will be 1.39% into 2.33, that comes to 3.24%. So the exchange can announce the initial margin to be 3.24% or rate higher, or maybe 3.5%, or depending upon how much margin of safety the exchange would like to keep with itself. Now let's say on 1st May 2016, a trader wants to take long futures position on 12 cotton contracts maturing on December 2016. Based on the initial margin of 4% announced by the exchange, find out how much margin will be paid by the trader if the trader takes long position at rupees 17,770 per bale. So that is one bale of cotton has 170 kgs. So trader's initial margin will be, the long position holder's initial margin is going to be 17,770 per bale into 25 bales per contract into 12 contracts. It took long position in 12 contracts into 4%, so that comes to 1,72,655 rupees. So the the broker of the trader is supposed to deposit, has to deposit a initial margin of 1,72,655 rupees to the clearing house. Now my next question to you all is that how much initial margin will be paid by the counterparty to the trader? So the trader who took long futures position, somebody else must have taken a short futures position. The answer to this question is the same, that is the trader is, the counterparty is also going to deposit 1,72,655 rupees, because the initial margin has to be paid by both long futures position and the short futures position. And whenever a party completely squares out, let's say this particular trader who took long futures position, 12 long futures position on 1st May would like to square up on, or squares up the contract on, let's say 7th May 2016, then on the same day he will be able to get back the initial margin what he had paid earlier. So this so whenever traders square up their position, whatever initial margin they have deposited, they get back from the clearing house. So let me summarize what we discussed in session 4. In the session 4 we discussed different aspects of delivery, settlement and delivery procedure. We discussed about how exchanges ask for premium or discount depending upon the quality variation, or in a additional delivery center if the if the seller is delivering goods in a center which is not the basis center mentioned in the commodity contract specification. The exchange asks the buyers to pay a little less than the due date rate or the final spot price arrived. And we also discussed how initial margin based on value at risk is calculated. Besides value at risk initial margin, we also discussed very briefly about the extreme loss margin and additional margin and special margin, as well as delivery period margin. Even if without going much into understanding of how each and every margin gets calculated, the basis of the most important understanding we must have at this point of time is that the exchanges levy these different types of margins so that a counterparty who is incurring loss, exchanges do not allow the loss to be inflated to a greater extent. So as and when a party is incurring loss because of the movement of the spot market or the futures market prices, they ask as and when whatever loss is happening, that should be contributed by the loss making party, so that the loss does not become too big to manage at a given point of time. So at this point of time, I would like to wind up the session 4 here. In the session 5, we'll continue to discuss how mark to market margin is calculated. We'll discuss how mark to market margin is calculated and other aspects of the forward contract specification. Thank you all of you.